Today we're doing a complete breakdown of AASB 101. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a time when companies could present financial statements in wildly different formats, leaving investors baffled. AASB 101 changed that by enforcing consistency and clarity. Now, with a unified approach, you'll understand how financial statements reflect a company's true performance, enhancing transparency and decision-making for all stakeholders. AASB 101 was introduced to bring uniformity to financial statements, tackling the chaos of inconsistent reporting. By standardizing formats, it ensures investors can compare and understand financial data across companies. This uniformity is crucial for transparency and informed decision-making, minimizing the risk of misinterpretation and errors in financial analysis. AASB 101 is mandatory for all Australian reporting entities, shaping how financial statements are crafted since January 2005. The pivotal requirement? Ensuring a true and fair view of financial performance. This consistency not only aids investors, but also aligns stakeholders on the entity's economic reality, fostering trust and credibility. The core presentation model, under AASB 101, dictates the precise layout of financial statements. It mandates a clear presentation of the balance sheet, income statement, equity changes, and cash flow, ensuring clarity and consistency. Mastering this model is invaluable, especially in interviews, as it underscores your expertise in financial reporting fundamentals. Scope is crucial, because missing exclusions can trip you up in high-stakes interviews. Candidates often forget that AASB 101 doesn't cover nonprofit entities. That's a classic trap. Understanding scope ensures you won't mistakenly apply the standard where it doesn't belong, saving you from costly errors. AASB 101 is the backbone for general-purpose financial statements, focusing on presenting financial position, performance, and cash flows. It ensures compliance with accounting standards, thus fostering reliability. For example, a retail chain's balance sheet and income statement must follow these presentation norms to ensure stakeholders make informed decisions. Remember, AASB 101 doesn't apply to nonprofit entities or specific industries like agriculture. These exclusions are common pitfalls. Many overlook that specialized financial statements have their own guidelines. Imagine a situation where a charity's reporting mistakenly follows AASB 101. That's a red flag for auditors and stakeholders alike. Financial statements are structured reports detailing an entity's financial health. They cover everything from assets and liabilities to income and expenses. For instance, a tech company's balance sheet shows its assets versus liabilities, while its cash flow statement indicates liquidity. These insights are pivotal for stakeholders assessing the entity's viability. Presentation in financial statements is crucial for clarity and consistency. AASB 101 ensures that financial information is displayed correctly, promoting comparability. For instance, a multinational's income statement must present revenue and expenses in a way that stakeholders can easily interpret and compare across periods. Improper presentation can mislead users, affecting decision-making. Edge cases often test a candidate's understanding. Consider, a charity reporting falls outside AASB 101. Similarly, specific industry reports like mining reserves don't apply. However, interim reports do align with AASB 101 for general-purpose financials. Startups? They must comply when creating general statements, offering clarity to investors and regulators. Financial statements should tell a clear story. Imagine you're an investor, trying to understand a company's health through its reports. The core presentation model ensures every number is accurately presented, providing a transparent view. This section reveals how AASB 101 delivers consistent and understandable financial statements. The core presentation model is your roadmap to crafting precise financial statements. It breaks down into 5 steps, ensuring clarity and compliance every step of the way. Our journey follows Meridian Corporation's $10 million SaaS deal. dissecting its $8 million software license and $2 million services. This model reveals a transparent financial picture, critical for stakeholders. Understanding who relies on financial statements is crucial. With Meridian Corporation's $10 million SaaS contract, identifying how investors perceive the $8 million software and $2 million services shapes our presentation. Missteps often occur when companies overlook key user needs, resulting in flawed disclosures. AASB mandates these statements provide relevant and reliable information. Here we ensure our purpose aligns with user expectations, setting the foundation for the next steps. With users identified, we outline the financial components. Meridian Corporation's contract sees $8 million reflected on the balance sheet as software, while $2 million affects revenue. A common error is neglecting elements like cash flow, leading to misinterpretation. AASB demands every component be captured, ensuring a full financial narrative. These components set the stage for compliance with presentation requirements. Compliance is key. AASB sets strict guidelines ensuring statements are clear and comparable. Meridian Corporation must disclose its $10 million SaaS contract properly, detailing revenue timing and obligations. Deviating from these standards can lead to confusion and misinterpretations. By adhering to AASB's format, we maintain uniformity, readying Meridian for actual statement preparation in the next step. Now we draft the financial statements, ensuring Meridian Corporation's $10 million contract is accurately reflected. The $8 million software appears as an asset, while $2 million is recognized as service revenue. Omitting crucial disclosures often results in incomplete reports, a pitfall to avoid. AASB requires detailed notes and breakdowns to accompany figures, ensuring stakeholders fully understand the financial implications. This groundwork prepares us for the final review step. A meticulous review ensures everything aligns with AASB, reflecting the true economic picture. Meridian Corporation must verify the $8 million software asset and $2 million service revenue meet contract terms and user needs. Skipping this crucial step often results in errors that mislead stakeholders. AASB stresses these final checks to uphold accuracy and prevent misstatements, culminating in a reliable financial presentation ready for stakeholder analysis. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. AASB 101 guides you on what measurement methods to apply and what disclosures are critical to provide stakeholders with a clear financial picture. To initially recognize an asset, AASB 101 requires meeting specific criteria: probable future benefits and reliable cost measurement. For example, inventory should include purchase price plus costs directly related to bringing the inventory to a saleable condition. Misjudging these can lead to significant balance sheet errors. After initial recognition, AASB 101 guides revaluation of assets to ensure they reflect fair value. Depreciation systematically allocates cost over useful life, while impairment tests check for value decline. This ongoing measurement ensures financial statements show accurate asset values, aiding stakeholder decision-making. Financial statements should accurately present assets and liabilities per AASB 101. Items like property, plant, and equipment must be at carrying value, and intangibles net of amortization. Clear classification and notes, like distinguishing current from non-current liabilities, aids in transparency and reliability. AASB 101 mandates critical disclosures. Accounting policies provide comparability, while judgments reveal management's reasoning. Estimation uncertainties indicate potential financial outcome variations, and fair value disclosures ensure transparency. Together, these form a foundation for stakeholders to assess financial health accurately. Imagine a CFO managing a $5 million asset acquisition, ensuring it fits recognition criteria. Quarterly revaluation adjusts its $1.5 million surplus, reflecting market shifts. An unexpected downturn leads to a $2 million impairment. Disclosures detail these transitions, offering clarity on financial position and strategic decisions. Every investor wants clarity on a company's performance, but inconsistent financial reporting muddles this picture. AASB 101 standardizes the presentation of financial statements, revealing true profitability and financial health. By the end of this section, You will be able to calculate this from scratch in any interview. Net income is a vital measure of profitability, calculated as total revenue minus total expenses. Imagine a firm with $1,200,000 in revenue and $700,000 in expenses. This leaves a net income of $500,000, showing the business's capacity for generating profit after covering all costs. Understanding each component is crucial for accurate financial analysis. When calculating net income from scratch, start by listing all revenue streams summing to $1 million. Next, total all expenses such as salaries and utilities, reaching $700,000. Subtract these expenses from revenue to reach $300,000 net income. Finally, double-check for any missed entries to ensure accuracy. This methodical approach is key during interviews when precision matters. Adjusted net income accounts for one-time events, refining the profit picture. Imagine a $100,000 gain from selling equipment. It boosts net income but doesn't reflect core operations. So calculate adjusted net income by adding or subtracting such items. This refinement is crucial for assessing long-term financial health, revealing a more stable trend by filtering out noise from irregular transactions. Common pitfalls during net income calculations include missing small revenue streams, which can significantly affect total figures. Additionally, misclassifying expenses may inflate costs, altering profit perception. Watch out for currency conversion issues if dealing with international transactions. Lastly, ensure prepayments are adjusted correctly to avoid distorting expense accounts. Precision is essential to avoid misrepresentations that can sway financial assessments during interviews. For Meridian Corporation, calculate net income by starting with $1,500,000 in total revenue from sales and service fees. Deduct $800,000 in operating expenses, which cover salaries and office rent. Account for $50,000 in annual interest expenses as well. The resulting net income is $650,000. This comprehensive calculation demonstrates a business's financial position, providing critical insights during assessments or interviews. It's time to test your skills with 3 scenarios. For the easy one, $900,000 revenue minus $600,000 expenses yields a straightforward net income. The medium challenge includes an exceptional gain requiring an adjustment. The hard level involves both a loss and an adjustment, demanding more complex calculations. Practice these to solidify your understanding of AASB 101 calculations, preparing you for real-world scenarios and interviews. Every Big Four and investment bank interview on AASB 101 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The primary objective of AASB 101 is to ensure that financial statements present a true and fair view of the company's financial position and performance. It's about standardizing presentation, not just disclosure, to improve comparability. Common mistakes include confusing presentation with disclosure requirements. Memorize. AASB 101 focuses on presentation to facilitate clarity and comparability. Materiality in AASB 101 ensures users focus on relevant information affecting decision-making. It's about presenting only significant data that influences investors. Avoid misunderstanding materiality as a fixed threshold. Key takeaway: materiality means relevance, not all data, just what impacts decisions. Dividends declared are recognized as a liability once declared, impacting retained earnings. They reduce equity and are not recorded as an expense. A common error is recording them in profit or loss. Remember, dividends affect equity, not profit, reflecting distribution of earnings. AASB 101 requires liabilities to be separated into current and non-current categories based on settlement timelines. Current liabilities are due within 12 months. Non-current are due after. Misclassifying them can mislead stakeholders. Key point: accurate classification impacts liquidity assessment. AASB 101 and Indian Accounting Standard 1 both aim for comparability, but differ in formats and terminology. Indian Accounting Standard 1 allows more alternatives in presentation, impacting areas like OCI. A common mistake is applying Indian Accounting Standard flexibility to AASB. Key takeaway: know the specific regional nuances. AASB 101 aligns closely with international financial reporting standards in classification, but regional adaptations can cause slight presentation variations. For example, terminology differences in equity might appear. Misunderstanding these can lead to incorrect application. Memorize. Always check local adaptations to international financial reporting standards for precise compliance. Under AASB 101, equity is calculated as total assets minus total liabilities. In this scenario, equity equals $200,000, $500,000 minus $300,000. Ensure you present it in the equity section, not as a liability or asset. Key reminder: equity reflects residual interest in assets after liabilities. Segment reporting is not covered under AASB 101, it's addressed by AASB 8. The confusion arises from presentation overlaps. AASB 101 focuses on overall financial statement presentation, not segment specifics. Memorize. Always verify scope against actual standards to avoid misinterpretation. A CFO must ensure disclosures under AASB 101 include significant accounting policies, judgments, and estimates affecting financial statements. Missteps often occur by omitting these, leading to incomplete disclosures. Essential takeaway: transparency in financial reports hinges on thorough and clear disclosures as per AASB 101. Materiality can trap candidates by assuming it's a fixed percentage or threshold. AASB 101 defines it as information's impact on decision-making. Misunderstanding this leads to inappropriate disclosures or omissions. Always assess materiality contextually, not numerically. Key takeaway: materiality is subjective, emphasizing user impact, not numbers. AASB 101's objective is to ensure fair presentation by setting guidelines for the structure of financial statements. It applies to all general-purpose financial statements under AASB. Definitions like current assets and liabilities play a crucial role in classification. At least 2 comparative years must be presented. Total comprehensive income is a key performance metric. Essential changes in equity must be shown, and comparative info is mandatory for all reported amounts. The core presentation model of AASB 101 distinguishes current and non-current balance sheet categories. It allows various measurement bases, such as historical cost and fair value. Materiality affects what gets disclosed and classified. Offsetting is restricted unless explicitly allowed. Specific line items like inventories need to be reported. Subclassification in the notes is necessary for material line items. Liabilities due within a year are classified as current. Beware of misclassifying items between current and non-current categories. It can lead to misstatements. AASB differs from international financial reporting standards with regional disclosures. Key judgments in applying policies require disclosure. Comparatives are essential for all figures. Significant judgments and estimation uncertainties must be disclosed, as these impact financial preparation. Changes in equity need clear disclosure, especially owner transactions. These points are crucial for interview discussions. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to CandiMentor for more accounting and finance videos. We'll see you in the next one.